Financial markets in turmoil.
What are the root causes of the financial crisis?
The dollar losing value.
Heading for its biggest loss in nearly 3 decades.
Will Social Security even be there?
I don't know.
Buy or rent?
That's a very good question.
Interest rates.
I'm not so sure.
Where do you put your money?
I don't know.
Welcome to the show that answers your questions. This is Follow the Money Weekly with your host, economist, and best-selling author. Here's Jerry Robinson.
Friends, welcome to you all around the world. Welcome to Follow the Money Radio. So grateful to have you here along for the ride, and welcome to episode number 416. As you can see, today's episode entitled, When Will the Fed Cut Rates? Kind of an interesting question as we are right here on the cusp of the Fed's meeting this week, where they're actually expected to raise rates by another 75 basis points. Now, we're recording this podcast episode before the Fed's meeting. And again, the Fed's July policy meeting slated for the 27th of July, and that is the day we're recording this, but we're recording it before the Fed's policy statement. We fully expect the Federal Reserve is going to raise interest rates by another 75 basis points. Now, that is actually in line with what happened last time whenever they raised interest rates by 75 basis points in June. And if you look at the expectations for the Federal Reserve, there had been for a period of time an expectation that the Fed would raise by 1%, but that was very brief, and that's actually when we saw the stock market pull back along with that. But now it does seem that the 75 basis point rate hike is kind of cooked in, kind of baked into the cake, and that's what we're expecting to see today. So the reason why we're asking when will the Fed cut rates in today's podcast episode is because, quite frankly, and without being too tongue-in-cheek and without being too sarcastic here, that's the reason why the Fed does raise rates, right? Understanding the rate lever that the Federal Reserve has is vital to being a wise, I would say, and savvy investor or trader. You see, the Fed really only has a few tools at its disposal, and one of them is to, of course, raise rates and then cut rates. But they really can't cut rates until they raise them, and they really can't raise rates until they have cut them or slashed them. For years, we've been living in a very low interest rate environment where the Federal Reserve had been very accommodative. Even through many of the years of the Trump administration, whenever the economy was so-called the greatest economy ever, the Fed was still keeping rates really low, historically low. In fact, there were questions as to why the Fed was not raising interest rates for a period of time. Now we are living in a time where the Fed is now finally unwinding a lot of the accommodative policy that it had, been using to aid the economy in the wake of the in the wake of the COVID response. We almost named this podcast the COVID response hangover. I mean, quite frankly, that's really what we're dealing with here. I think in order to fully understand 2022 and the economy that we have today, you have to put it in context. You have to remember what happened in 2020. We really are living with a hangover here. You can't go out to the bar and consume a lot of alcohol and then come home and then not have a hangover the next day, right? You're going to feel it, right? You just can't go out or food. You can't just, eat a ton of food and then not feel it afterwards. You're going to feel it, right? So there's a hangover here. And what happens oftentimes, and usually due to politics, is people will forget that what's happening right now is a result of something that happened before, right? And so if you want to understand 2022, you have to understand 2020. Just like if you want to understand 2020, you have to understand 2008, right? So you have to kind of put all of this into context. And I want to talk about 2020 because I want to explain just a little bit about the origins of where we are today with the economy. But when you look around the economy, we see some problems, right? We see inflation, of course, has been raging now for some time. This should not have been a surprise. The inflation was, pretty much baked into the cake when the Federal Reserve began printing more money than it ever had in its history in 2020. We've seen people beginning to become concerned about home prices. Of course, they've been outrageous, but now suddenly you're beginning to see a slowdown in pending sales, right? You're seeing, in fact, in June, we had pending home sales fall 20% versus a year earlier, largely due to mortgage rates that are going up and prices which are still very stubbornly high. So it's caused a bit of a cratering in demand for houses, even though the supplies remain still razor thin. That may change. And in fact, we see as we are looking forward, we're expecting a much softer housing market by the end of the year, very likely into next year as all of this works itself out. So we certainly are seeing a lot of disarticulation, a lot of wild moves in the economy. We even got a profit warning from Walmart, the second warning we received over the last couple of months now from Walmart. Of course, Walmart's the largest retailer in the United States, and they just put out a new business update along with revised profit outlook for Q2 and the full year. And they warn investors that this persistent food and fuel inflation has caused consumers to shift their spending away from general merchandise in the store. So, many of the Walmart customers are avoiding the apparel section of the store. They're avoiding the furnishing section of the store because they're just trying to afford the grocery bill, right? Because the grocery bill has risen and risen and risen. So it's crimping the ability of consumers to go spend on discretionary items. So really what we have here, at least what we read from Walmart's report, is that American consumers are still buying staples at a solid pace, but the rising prices of those staples have increasingly crimped discretionary spending by consumers. And that's something that we've seen not just from Walmart. Target also issued a similar warning. They revealed a serious decline in revenues earlier this year and have been addressing that problem by lots of markdowns in prices, discounting strategies. Walmart's going to have to do the same thing, and they already have been. They've been marking things down. Bed Bath & Beyond, The Gap, Restoration Hardware, many of these retail companies. I mean, if Walmart is having a tough time, if Target is having a tough time, and they're the smartest guys in the room in the retail space, then how much more so are, companies like Bed Bath & Beyond and Gap and all these other retail outlets that don't have the same, pricing power and economies of scale enjoyed by somebody like Walmart. So we're seeing that. We're seeing lots of concerns there. We also have this week, on Thursday, we're going to get the GDP numbers, the Q2 GDP numbers, which many people are watching. For weeks, Wall Street has been fixated on whether a recession is looming, whether it's imminent, or whether it's already here. And as I stated, this is as much a political question as it is an economic question. And this Thursday, we're going to be able to see, we're going to have a better grasp of where the U.S. economy stands when it comes to the latest quarterly GDP figures. Most analysts and economists are anticipating a negative report. For example, the Atlanta Fed GDP Now website suggesting a decline of about 1.6% for the second quarter. That would come on the heels of another negative quarter back in Q1. And the rule of thumb is when you have two back-to-back or two consecutive quarterly declines in GDP, that's a rule of thumb that you're dealing with a potential recession there, right? It's not always automatically, named a recession because there are other factors. You have to consider in, other ideas like the inventory levels and the current unemployment rate. And that's what makes our present situation so unusual, is the fact that we still have a very tight labor market. Consumers are still spending a lot. So you have a very mixed picture here. And this is why the earnings this week, by the way, we have a slew of earnings this week. Companies like Microsoft, which already reported, Alphabet, which already reported as well. Their stocks rose even though their reports came in a little less than desired. They came in a little less than expected, although there were a few positive surprises in those. Facebook reporting this week, Visa, Enphase, Coca-Cola, UPS, Shopify, Ford, Apple, Amazon, Intel, ExxonMobil, Chevron. I mean, you talk about a big earnings week. This is the biggest market-moving week of the summer, for sure. And traders and investors are going to get a slew of new data to help them discern the current state of the economy. And so many investors are listening closely to these earning calls. They want to hear from Amazon. They want to hear from, Amazon, the second largest retailer in America behind Walmart. And in fact, by 2024, Amazon is expected to be pulling in more revenues than Walmart. Right now, Walmart, many people don't know this, but Walmart is when it comes to the money that comes into a company, there's no company on the face of the planet that brings in more revenue on an annual basis. So Walmart brings in, I think, around $569 billion, more than $500 billion is what they bring in sales every year. Now, Amazon is, somewhere in the $400 billion range. So Amazon is number two right behind them. And so when you look at that, you say, well, you got to listen to what Walmart is saying. I mean, they know about the consumer. They have an incredible view, if you will, of the U.S. consumer, the U.S. household spending. You just don't get much more intelligent than Walmart's ability and view of the U.S. consumer when it comes to retail in this. Amazon, also very interesting, what they're going to be able to provide. They'll be reporting on Thursday. So lots of people watching these earnings that are going to be coming in. And so far, around 20% of the S&P 500 companies have already reported, and about 70% of them have already beaten expectations by analysts. This week, we have, 175 S&P 500 companies reporting. That's about a third of all the companies, on the index. So it's a big week for earnings. And also, of course, the Fed meeting with that Q2 GDP data in view. Now, the Fed has been admitting, that it misread inflation, and they're trying to course correct now. The IMF recently slashing global GDP forecasts and its economic outlook as well. The IMF now expects the world economy to grow about 3.2% this year before slowing to about a 2.9% GDP rate in 2023. That's quite a bit of a downgrade from what they had released back in April. They were expecting around 3.6% growth in the global economy earlier this year for the whole year. They were expecting about 3.6% GDP rate next year. And of course, that's certainly come down. So the Fed is a day late, a dollar short. It's behind the curveball here, trying to raise rates and get ahead of the inflation. But what may surprise some investors is the fact that this is, or maybe I should say what we're dealing with right now, is a result of not what happened this year, but what we have been living through up until this time, right? So 2022 doesn't exist in a vacuum. It's not just all of a sudden, wow, what happened to the economy? The economy, quite frankly, should have gone through a recession back in 2020, right? Remember what happened back in 2020. We have to understand 2020 in order to understand 2022. So in 2020, in the beginning of the year, the United States reacted to the COVID-19 pandemic, right? And what they did was they made decisions. Washington made decisions. And what they decided to do in reaction to the COVID-19 situation is to print lots of money, to hand out checks to people around the country, right? They also chose to open up a PPP loan program where they were providing people with paycheck loans and things like this to get companies through a tough time. Of course, when you drill down on that PPP loan situation, you'll find a tremendous amount of waste, a tremendous amount of fraud. I mean, 20% of the loans, it's been estimated, were, made to fraudulent actors or were fraudulent in nature. So, you have a lot there. Then you have, of course, the printing of money. The United States printed more money in June of 2020. We got to go back now 2 years, right? 2 years. Because there's a lag effect in economics. And so you don't automatically see the repercussions from every single fiscal or monetary act in real time. It takes time for the actions of monetary and fiscal policymakers to work its way through the economy. And so back in June of 2020, just a mere 2 years ago, the United States, specifically the Federal Reserve, printed more money in that month than they did for the first 2 centuries after the founding in 1776. 2 centuries of debt in one single month, right? And the federal government, set an all-time record at the time for the amount of money spent in the first month of a fiscal year when it spent $522 billion in the month of October 2020, right? So you have massive money printing in 2020. You have the government sending out checks, right, fiscal policy makers signing off, both parties saying, let's send checks to the American people. Then you have the PPP program, which is full of fraud and waste. And now here we are in 2022, after all of this money has been injected into the economy. Remember now what 2020 was. 2020 was an election year, right? So what should you have had in 2020? Well, you should have had a recession. You should have had the economy have to deal with a downturn, and it should have had to deal with a recession at the time. It should have been dealing with this slowdown then. But instead of dealing with the slowdown, instead of actually embracing that situation and trying to figure out how to handle it, like many other countries did, for example, other countries did not lower their interest rates to zero and print more money than the world has ever seen. Not everybody did this. Some countries dealt differently with the COVID-19 situation in a way that didn't cause the creation of more money in 1 month than they had created over the last 2 centuries, right? Not everybody took on record deficit spending in order to deal with the COVID-19 situation the way that the United States did. The United States did it differently than many other nations, and it did it by dousing the economy with an incredible amount of money. Helicopter money from the Federal Reserve, 0% interest rates pushing out strong loan growth across the board. And then, of course, you had the checks that were being signed by President Trump and sent out to, in fact, the checks had to be brought back to Washington so that Trump could sign them before they went back out, that he wanted his big signature on those checks. Remember, there were PPP loans, many of which were fraudulent. Okay, where's the investigation into the COVID response that has crippled our economy, right? Where is the there's a lot of investigations going on, right? There's a lot of investigations going on. On the left, they're obsessed with January 6th, and they're investigating that. On the right, many of them are obsessed with a quote-unquote stolen election, and they want to investigate that. But where are the people who are going to investigate the COVID-19 response, right? Where are these people? Where is the demand to find out why the Federal Reserve printed more money in 1 month than they had printed for the past 2 centuries to deal with COVID-19, right? In the middle of an election year, right? Where are the investigations into the PPP fraud loans that we had, right? Where is the investigation? Where are the taxpayers? Where are the taxpayers upset and outraged about this, right? So we live now in 2022, and we are living now where now they're unwinding this. So they printed all this money in the middle of an election year, right, to keep the economy looking fine, right? And then they eventually are going to have to stop. They stopped that in 2021, right? And so then they start reeling it back in, and people say, what's going on? Why is the economy? Well, you just lived through an incredible injection of monetary supply and all of these checks being mailed out on a monthly basis. And then they turn around and stop doing it. Of course, you're going to have whiplash in your economy, right? Of course, we're going to be dealing with all kinds of problems when you intervene that way and then suddenly stop intervening that way, right? Of course, you're going to have it. So here we are in 2022, and many people are scratching their heads saying, what just happened? What just happened was we're dealing with the COVID-19 response hangover, right? This is a hangover from the crazy policies that we had in 2020, right? So now it's not as if we see the policies are getting any better here in the United States. Of course not, right? In fact, we're in a midterm election year, so we should expect more shenanigans and even more shenanigans by 2024. And this is my point to you, is that politicians want rates to go which way? Well, politicians always want cheap rates. Hey, everybody wants cheap rates. So they're going to drive rates back down eventually. That's what the public demands. That's what the public wants. We want cheap gas prices. Americans want cheap gas prices. We want cheap interest rates, right? We want cheap access to money. We want cheap goods. We want cheap imports. Everything needs to be cheap. Of course, that's the demand that people have. Well, we're in a situation now where the rates have to go up to bring down inflation. And there's a report out from the Wall Street Journal that just came out a few days ago entitled, Investors Bet Fed will need to cut interest rates next year to bolster the economy. Listen to this right here. This is from Sam Goldfarb, dated July 25th, 2022, Wall Street Journal. It says, as the Federal Reserve prepares to meet this week, Wall Street investors are betting that officials will raise interest rates aggressively through the end of the year, and watch this, and then turn around and start cutting them in 6 months. The unusual wager reflects investors' growing sense that the Fed is driving the economy into a recession as it tries to fight inflation. At the same time, by constraining longer-term borrowing costs, it makes a recession slightly less likely to happen soon. That is a boost to riskier assets such as stocks compared to a more traditional bet that rates wouldn't boomerang so quickly. So basically what we have here is if you're looking at the expected federal funds rate, what you see is that rate rising based upon Wall Street expectations, the rate rising somewhere below, just south of 3.5%. Another part of the article goes on to say, as of Friday, that's as of last Friday, the data showed that investors expect the Fed to raise its benchmark federal funds rate by 0.75 percentage point on Wednesday. That's this week. The Fed is subsequently expected to lift the federal funds rate to around 3.3% by the end of the year, but investors expect no further increases after that, and they are betting that the Fed will be cutting rates by June, bringing short-term rates to roughly 2.5% by the middle of 2024. Goes on to say that the Fed has cut rates within a year of raising them several times in the past, most recently in 2019 when officials cut rates by 0.25 percentage point in late July. Remember back in 2019, the greatest economy ever, they were cutting interest rates, right? So the point is that the Fed, of course, they do raise interest rates. That is a tool that they have. In essence, the Federal Reserve is going very likely to cut these rates so as to keep the facade going, right? Certainly Americans cannot handle a sustained interest rate that is elevated, a sustained elevated interest rate, say 3 or 4 or 5%. I mean, this would really damage the debt-based monetary system that we have here. And so the Fed knows that it can only be raising interest rates like this for a little bit of time. And investors are betting, basically, that the Fed is going to be able to rein in inflation perceptions enough, and that they will be cornered in the fact that even if they don't get inflation down to the level that they want, the economy will slow to a pace due to these interest rate hikes that will cause the Fed to have to turn around and pivot, right? So you're looking for a Fed pivot. And here's the thing. The stock market is a voting machine. It's usually about 6 months ahead of everything, right? So it's pricing in information, and it's usually many months ahead. So what we're beginning to see now in Q2, because Q1 was devastating for the stock market. I mean, it was incredibly devastating. Q2, we've actually seen a healthy rebound here, and it's possible that the market is going to begin pricing in those rate cuts that they expect next year. And you could begin to see that pricing in, over the next, several months as the market begins to look forward to the fact that, yes, the Fed is going to have to stop raising interest rates at some point, and then it'll probably immediately start cutting them. Remember, as I said at the beginning or the outset of this podcast episode, the reason why the Federal Reserve raises rates, obviously is to control policy, but also to be able to have room to cut them, right? That's a huge part of their arsenal. So one of the problems that the Fed had was that they were sitting when they're sitting at certain levels, like at zero, they're worried if interest rates at zero, they have no room to cut, right? So they got to push it up a little bit so they can turn around and cut it. Likewise, whenever interest rates are high, they need to get them down so that they can raise them again, whatever. So whatever they're trying to do, they use that lever of the interest rate. And that is a powerful, powerful thing. But realize they move it back and forth, back and forth. So some people get stuck in a moment and they think, well, the Fed's raising rates and they're never going to stop. It's always going to keep going up. And so that, that kind of creates an economic pessimism that swings the pendulum too far. And so anyway, the point being here is that we expect that the Fed will begin cutting rates as soon as they possibly can, right? Of course, they're raising interest rates right now. Of course, they're raising interest rates right now with inflation high and market expectations for higher rates. However, this is a temporary thing, right? This is a temporary thing. We're going to see the Fed get to a place where it feels like inflation expectations are falling, and it may even be the very first monthly print where we see a contraction in the official CPI numbers. We still see CPI rising every month, but when we finally get a contraction, and look at commodity prices. I mean, commodity prices have certainly fallen. Oil prices, I mean, natural gas is kind of an outlier. It was up like 80% this month. Wild swings in the price of natural gas. But, many commodities. Look at silver. I mean, look at copper. Look at some of the base metals. Look at the grains. Many of them have fallen. We even had a recent deal between Russia and Ukraine allowing the food exports to be able to get out of these ports, which is going to really alleviate some of the food pressures on Africa in particular. So, we're seeing prices in the commodity space really deflate. Well, those are input costs that eventually work their way into consumer costs, which is where you're dealing with this inflation. So, seeing these prices come down, it certainly looks like the peak in inflation, at least now, has been reached because the input costs have come down. Now, it doesn't mean that we couldn't have another peak in this. It doesn't mean that we couldn't see commodity prices just hightail it back up and do it all over again. However, it does seem that many of these input costs are off their highs, and that is going to translate into overall lower prices for the finished goods. And that means that we would very likely see that there is some peaking in inflation as we go forward over the next few months. And that's going to provide the ammunition for the Fed to ease off of its rate hike strategy and then begin to move into a place where it pauses and then begins to cut rates so as to prop up an economy that is facing or already in a recession, right? Some of this will be determined by the GDP numbers that come out this week. If the GDP numbers do conclusively show a negative overall print, that is also going to be a very interesting part of the equation for the Fed going forward. So the Fed in a place where it's raising rates, yes, right now, but it is, believe me, it is eager to begin cutting them because then it takes the pressure off of itself. And of course, remember, when we get to that place, don't forget that the market is very manic and investors are very manic. And so when we get to that place where we do pause, the Federal Reserve is pausing, and then they begin to try to cut rates, it'll become a big debate. Will they cut by 25 basis points? Will they cut by 50? Will they cut by 75? Oh, they thought they were going to cut by 50, but they only got 20. And so then you suddenly have this dance again. So nothing is ever set in stone. And of course, it's all going to be micro-analyzed every single step of the way, right? So you got to keep that in mind, that the Fed, has this broad agenda, and that agenda involves trying to stay out of the crosshairs of Washington and the American people, right? And raising rates is a really good way to put a target on their back. So they're eager to turn that ship around and start lowering rates. The problem is they were a major contributor to this monetary inflation that we're dealing with. So they have to do something about it. They played dumb for a long time. There was a clip, I don't have the clip here, but you may recall that Jerome Powell back in the beginning of 2021 was saying on record, they got to have him on video, saying that the M2 money supply, the expansion of the M2 money supply is meaningless, right? Practically meaningless. So there's no connection to the economy. And of course, they were, for those of you who don't know what M2 money is, that's a big part of the overall economy. That's the amount of money that's in the system, not M3, but it's M2. And of course, pumping up, the M2, which was up trillions and trillions of dollars, of course it led to inflation. I mean, it's incredible how the Fed really supposedly got this wrong. It's hard to believe these guys really didn't know what was coming. They're trying to play ignorant now, saying, well, we didn't know, that throwing trillions and trillions of dollars into the economy would distort the economy. We had no idea. Well, sure. Okay. I don't know. Who's supposed to believe that? Do we believe that? I don't believe that. I don't believe the Fed's that ignorant. I believe they know what they're doing. And they thought they might be able to get away with it, but they didn't. But here's my point. We have had a tremendous amount of poor economic policy coming out of Washington for years, right? Nothing new. But in 2020, they put the pedal to the metal over COVID-19, okay? COVID-19. So they saw COVID-19 and they did what? Well, they put the pedal to the metal. It was an election year, wasn't it? So you start doing all the math and you start thinking, so where's the investigation into this, right? We're going to do this all over again every single time something happens. How can we afford to do this how can we afford such poor policies going forward? How can we not investigate this? How can taxpayers not be outraged that the Federal Reserve and the White House and the Congress, all of them in 2020, were just gushing forth lots and lots and lots and lots of freshly printed money instead of dealing with it? Instead of, they just literally kicked the can down the road. They're like, we'll just print money. That's what we'll do. Not every country did this. Not every country handled this situation so poorly with their economy. Not everybody did this. Where are the investigations? When are we going to look into this, right? Well, we won't. I think that's probably the biggest thing to take away here is that they're not going to investigate it, right? Because neither side sees it as a problem. Like I said, the Republicans think the biggest problem from 2020 is the stolen election, quote unquote. The Democrats think the biggest problem from 2020 is the January 6th. And while I will concede that was a disaster and ridiculous, I mean, we also have to investigate, this wild economic situation that was going on in 2020 that nobody has any answers for, right? So we're all living with the fallout from it. It's created tremendous distortions. And these distortions just didn't pop up. They just didn't arise. It wasn't just something that just suddenly happened in 2022. These things were laid a couple of years ago, right? And we have been dealing with the fallout ever since. So to answer the question, when will the Fed cut rates, is simply that we believe that the answer is as soon as possible. Right? That the Fed is not going to linger here. They're not going to try to take their time. They're trying to get these rates to a place where, but not too high. And then they want people to believe that inflation is coming down. And once they do, that'll give them a permission slip to start cutting the rates. And in fact, I want you to know this. It's possible that the inflation will not get back to the 2% goal that they have before they begin cutting rates. Now, the reason is because of recessionary fears, right? If the economy is slowing at a pace that the Fed deems it to be too slow, then it's going to begin to cut rates even if inflation is high. And I would suggest to you that some of the American people may be okay with that. That, in other words, one of the dangerous things about inflation is that people can get somewhat accustomed to it. Right? None of this is new, by the way. You've been dealing with inflation for a long time. I've been dealing with inflation for a long time. It's only that they have accelerated the inflation and made it much more pronounced through their incredibly poor policies from 2020. That we are now dealing with this pronounced situation where, everybody knows about inflation. But inflation has been there. I mean, it's been an insidious thing that's been going on and on and on for a long time. So it's not new. It's not a 2022 phenomenon. It's been around for a long time. It's been stealing and robbing you of your wealth for a long time. It's only gotten more worse recently because why? Because they just dumped a tremendous amount of money into the economy in 2020, and now they're trying to suck it all out, right? Well, good luck with that. What a disaster. What a total disaster it's been, right? You have a $30 trillion national debt, right? Unsustainable debt. That's the equivalent of hundreds of thousands of dollars of debt per taxpayer, right? You have annual interest payments on the debt that are going to triple, if not quadruple, by 2028. You have the national debt rising so much faster than the economy, right? It's taking around $5 or $6 of debt to create $1 of GDP in the United States today. You have unfunded pension liabilities that are trillions and trillions of dollars with very few solutions. You have a Social Security trust fund that's going to be depleted probably within, maybe a decade. You have the Medicare hospital insurance fund that's going to be, it's almost depleted. It's going to be depleted, pretty soon. You have tremendous unfunded liabilities by Washington. There's going to be a tremendous number of broken promises, not only by the federal government, by the states, which are drowning in debt, local debt, corporate debt is sitting at outrageous levels, total personal debt, Credit card debt sitting just below all-time highs. Auto loans, still way up in the stratosphere as far as the number of loans and the amount of loans. Student loans, people are still dealing with. Credit card debt, as I mentioned, is very high. And then, of course, you have many people who aren't even saving. They have zero retirement savings, right? 40% of Americans would struggle to cover a $400 emergency. 2/3 of American families say they're living paycheck to paycheck, right? Mortgage debt is outrageous. People can't even afford to buy a house, right? And so America's leveraged to the hilt, and it faces rising competition around the world. But you can't infer from all of that data that the Federal Reserve or Washington is going to do anything that's going to fix it. They're only going to put Band-Aids on it. So, of course, they're going to try to cut rates as soon as they can because their solution is a Band-Aid. It's always a Band-Aid. It's always kicking it down the road, right? Nobody's taking responsibility for this stuff. Neither political party is trying to solve these things I'm talking about. Like I said, they have their own pet projects that they're worried about, but they're not at all concerned about what's happening to the economy in a real meaningful way. Oh, they care about it for political points. They care about it for scoring but they don't really care about solving it. And that's what I'm talking about here, right? So the Fed will eventually cut rates. We expect it'll be, probably the first part, if not the middle of next year. And that'll be helpful for people who are trying to buy a home, especially when we think about housing. And I don't want to get into housing now, but I do see that housing prices are very likely going to be coming down sharply in some areas, not all areas. But this is going to be, I think, an opportunity for those who want to be buying real estate. There's going to be some opportunities, I believe. Opportunities are going to abound. We've already seen a tremendous number of opportunities in the stock market. Some very high quality companies have been, smashed in their valuations compared to where they were, say, just a year ago. So, there are a lot of opportunities out there for those who are being prudent in this environment. One of the things I recently told our members, too, is that one of the best things you can do in this environment, if you really want to protect yourself, is to deleverage yourself. If you're, leveraged to the hilt, if you have a tremendous amount of debt, then America's problems are going to amplify your own problems, right? But if you can deleverage, if you can get yourself in a situation where you're not up to your own eyeballs in debt, and you can have some cash on hand and get yourself in a better situation, then you will be able to benefit, I believe, from the situation that is unfolding before us. So lots there to cover. And of course, a lot more coming this week. So the Fed, of course, still hasn't said what they're going to do, but we expect 75 basis point rate hike. The GDP print coming out Thursday, we expect I would say it's probably going to be negative, but there are some who are expecting a positive print. We'll have to see what it says. And then, of course, the rest of the corporate earnings week, plenty of surprises, I'm sure, still ahead. So buckle up for the rest of this very wild week.
And Follow the Money returns after this.
Hey friends, Jerry Robinson here from Follow the Money Radio. Many of you who listen to our podcast regularly may not know that we have a membership that you can become a part of. You can actually become a gold, a platinum, or a silver member here at followthemoney.com. And when you become a member, not only do you get access to a tremendous amount of resources, but one of the most powerful things that many of our members report is our daily newsletter that we send out. Right now, if you're not getting our daily email newsletter where you get my commentary and my latest trading idea, you're missing out, especially right now with all the things that are happening in the economy. We also have a weekly coaching call for all of our gold and platinum members, providing them an hour-long live mentoring call with myself personally, where we go over what's happening in the economy. We may even provide some sort of course. We cover all kinds of material in those live Tuesday morning coaching calls. Then, of course, they're archived forever for all of our members to go back in and watch. So we have so much here to offer So much more than just the podcast. So if you're interested in learning more about our services, go to followthemoney.com/join. Take advantage of our summer sale. No coupon code is required. Just simply join. Check it out. We have a 30-day money-back guarantee. I think you'll absolutely be surprised at all of the great resources that are waiting for you right here at followthemoney.com. Followthemoney.com/join. Summer sale, no coupon code required, 25% off all of our memberships. I hope to see you on the other side. All right, friends, welcome back to the program. Our final moments here as we close out today's broadcast. I hope this was helpful for you. So the question we asked today hopefully was answered in the podcast. When will the Fed cut rates? We believe within the next 12 months. That may seem surprising to some, but that seems to be the way the Fed tends to work, at least over time. We could be wrong, but we'll have to let time tell. We'll be watching. And as always, I like to leave you with a final word, this time an ancient Chinese proverb. It goes like this: a single conversation across the table with a wise man is worth a month's study of books. You know, the dictionary defines the word mentor as a wise and trusted counselor or teacher. You can also refer to them as a coach. Very few people achieve great success without a personal mentor. A mentor gives us perspective, and they can help us understand patience, the need for patience. And while I am a big fan of reading books and promote books all the time as a great way to learn, nothing can replace a mentor in your life. If you're fortunate enough to have a mentor or a coach in your life, that's a wonderful thing. And if you don't, I encourage you to seek it out. Perhaps one of the greatest benefits of having a mentor is learning the mistakes that you shouldn't make again, right? Learn from the mistakes of others. That's just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
The information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.